With the stock market close to its all-time highs, many investors are still looking for those bargains, those companies, those stocks that are yet to recover from their previous down cycle. The two companies we're going to talk about in this video has seen their stock crash 78% since their all-time highs. Not just because they once reached those highs does not mean that they'll ever reach those again. The business itself has to show accelerating growth, accelerating profitability as well. Now, even if it doesn't reach all-time highs ever again, in the last 5 years, those two stocks are also down. Actually, they're down over 40% in the past 5 years. So in my opinion, right now they do still provide quite some nice upside, and I'll explain this video why. If you enjoy this type of videos, leave it a thumbs up, subscribe if not. We're very close to reaching 40,000 subscribers, so thank you very much for all the support. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So the first company I'm going to touch on is a controversial one for many, and that's Alibaba. It's controversial because it is a Chinese company. We know Chinese controlled companies, you don't have the same voting rights as if you're holding shares of an American company or a European one, plus you have added risk and pressure from the Chinese government. But in my opinion, looking at Alibaba right now, at market cap of $174.3 billion, one share will cost you just $72 or so. Year to date, it's down 7.55%. Like I said, in the past 5 years, this stock has done horribly. But as you can see, since 2021, shares outstanding have come down quite fast. And in the last couple of years, if you look at free cash flow per share, that has exploded. So you, as a holder of Alibaba shares, you now have shares that are worth actually way more than before, despite the stock price being down quite a lot. Which means that when the stock will go up, you will benefit quite a lot more. Now, if you look at a couple of valuation metrics, forward PE, EV to EBITDA, price to sales, it's extremely cheap. Even compared to its own 5-year mean, it's very, very cheap right now. Price to free cash flow trading at 8.1 times. That's in the last 12 months, 8.1 times. Price to free cash flow to me is extremely cheap. And then price earnings to growth at 0.68. I mean, it doesn't get cheaper than that. And this is a company that is a giant in the e-commerce space, a giant in the logistics space, cloud in Asia Pacific as well. But yes, of course, we know the China risk is obviously one of the reasons why you're seeing all of these metrics trading at, well, I think the lowest point ever. Now, if you want a better visual representation of Alibaba's business, as you can see, revenue over the years have gone up over 1,725%. Free cash flow per share has exploded as well. Return on equity is a bit stable at around 8.2%, but gross profit margin has come down drastically in the last couple of years. Return on capital is now at 6%. So yes, there are some reasons why the stock has taken a hit. Of course, shutdowns in China, pandemic, government pressure, etc., etc. Those are all very, very real risks. But if we purely looked at the business has been growing and performing quite well. Yes, on the profitability side of things, it did take a small hit. If we currently look at the average analyst price target, it still sits at over $100 at $106.18, representing 48.17% upside from the price we're at today. If you look at what the analysts are expecting in the next coming fiscal years, for fiscal year 2024, sales growth of just 3% year over year, but EPS growing 9.5%. Going to fiscal year 2025, it's a bit of a flip. Sales growth of 7.7% year over year, and then EPS basically staying flat. But then a re-acceleration top and bottom line in fiscal year 2026, top line growing close to 8% and EPS growing 11.62% year over year. As you can see here again, the last 5 years, this stock is down close to 60%. Now, more recently, Alibaba shared some news with regards to their share buyback program. So during the quarter ending March 31st, 2024, they repurchased a total of 524 million ordinary shares for a total of $4.8 billion. These purchases were made in both the US and Hong Kong markets under their share repurchase program, which, by the way, they announced last quarter, right, was, I think, close to $25 billion, around 17% or so of the market cap. So quite a big one. And as you can see here, net reduction in total share outstanding, it's down 5.1% year over year. So if the stock doesn't go up, well, the value of your shares become more valuable because they are now buying quite a lot of shares. They also announced the withdrawal of the China IPO application and proposal to acquire all outstanding shares from China minority shareholders. So Alibaba Group plans to offer to minority shareholders of China, including employees, an opportunity to sell all of the outstanding shares of China held by them to Alibaba Group for around 62 cents per share, representing a total consideration of up to $3.75 billion. After completion of the offer, Alibaba Group plans to align part of China's business to better realize strategic synergies with Taobao and Tmall Group and Alibaba International Digital Commerce Group, as well as support China to execute a long-term strategic expansion of its global logistics network. And earlier today, there was a report that said that Alibaba is cutting prices for its cloud customers globally by up to 59% amid increasing competition to fend off rivals and attract AI software developers. The Chinese tech giant said the products related to computing, storage, network, database, and big data will see on average a 23% reduction in prices. These price cuts are for about 500 cloud product specifications, and the discounts are now available to customers in 13 regions, including Japan, Indonesia, the UAE, and Germany. This is the third time the company has reduced prices over the past year. Now we know that Alibaba Cloud's growth has not been great at all. So this is another attempt for them to reaccelerate growth of that segment of the business. So in short, that's Alibaba, a very, very dominant player in the e-commerce space, in the logistics space, cloud in their region as well. Company is making strides towards rewarding shareholders because they do know that, well, they are publicly listed. If they want to attract talent, if you want to attract investors, I mean, you will have to show investors that you are willing to reward them one way or the other. Dividends, share buybacks, more investments, etc., etc. I think that right now at these prices, it's quite attractive. Of course, I do acknowledge the risk attached to it, so allocate accordingly. Then stock number 2, a bit less risk in my opinion. It's a US company. It's a company I personally own as well. I'm a big fan of them, and that's PayPal. We've talked about PayPal quite a lot on this channel. And yes, PayPal as well is down 40% in the last 5 years, down 78% since its all-time highs back in 2021 or so. And yet, even if the stock year to date is up a remarkable 6% or so, it still only has a market cap of $69 billion. One share will cost you $65.25 at the time of making this video. As you can see, shares outstanding in the last couple of years have come down close to 12%, while free cash flow has gone up quite a lot as well. But I do still think that we will see free cash flow increase meaningfully in the years to come. If you look at forward PE, EV to EBITDA, price to sales, still very, very cheap, especially compared to its 5-year mean. But of course, its 5-year mean is a bit, let's say, high because of the pandemic period here. But still, even if you remove that, you are quite lower than the mean. For PE, 12.7 times, EV to EBITDA 9.3 times, price to sales 2.2 times, even price to free cash flow 16.5 times in the last 12 months, and then price earnings to growth 1.36 times, to me is still quite cheap, and the risk reward here is probably still one of the best out there. And yes, this is basically the difference that you can see. PayPal, an American company, very, very cheap. We've seen Alibaba just before. Alibaba much cheaper on each and every metric here, but of course you are getting the China discount. Then if you look at what the average analyst price target is, it's now at $72.31, representing close to 11% upside from the price we're at today. And if you look at what the analysts are expecting for the coming fiscal years, EPS growth for fiscal year 2024 to be flat, year-over-year sales growth 7%, and will be a bit like this for the next 2 fiscal years, maybe even closer to 8%, but EPS is expected to grow 9 to 8% year-over-year for the upcoming 2 fiscal years. Now with regards to PayPal, I've covered this company quite a lot of times on this channel, so you can go and watch the other videos to get my full thesis on that. But one of the main things that we should be looking at is transaction take rate. Transaction take rate has been trending down for quite a while. Last quarter that ticked up a little bit. Let's see if that can continue. Another thing that ticked up last quarter was very surprising. Transaction margin was 45.8%, up from 45.4%, but still down from 49.7% same quarter a year ago. Now, yes, I know active accounts has come down. It's an issue, but in my opinion, if you look at the increase in number of payment transactions, that has increased. Payment transactions per active accounts, that has increased as well, and TPV has increased as well. So yes, active accounts have come down, but as you know, they're not looking for quantity anymore, like in the pandemic period, but they're looking for quality. Then more recently, this news came out. For some of you, this might be a nothing burger, but we've talked about this stablecoin effect on this channel with Roy a couple of times. And this announcement is just the start of, I think, something quite big. So Zoom enables PayPal USD as a funding option for cross-border money transfers. This means that it will allow US Zoom users to easily convert to PayUSD in their linked PayPal cryptocurrency hub to USD and use that as a funding source to send money to recipients in approximately 160 countries globally with no Zoom transaction fees. According to the World Bank Q3 2023 report, the global average cost of sending $200 is just 6%. I mean, just 6% in my opinion is still quite high. With no Zoom transaction fees, cross-border money transfer funded using USD converted from PayUSD provides a lower cost option on Zoom. Of course, they're competing here heavily with Wise. Lots of people are using Wise because it was and still is probably way cheaper, but I do think that this will be a game changer. Couple of comments here. When we decided to bring PayUSD to market, we had two objectives. We wanted to create something that had a stable value to maximize user confidence and ensure it had utility for commerce and payments. Enabling US users of Zoom the option to fund cross-border money transfer using PayUSD built on our goal of driving mainstream adoption of cryptocurrencies while also offering an easy way to securely send money to friends and family at a lower cost. It's going to be a very, very big deal because more recently we've had this announcement as well. PayPal and Venmo begin offering Visa plus P2P payments, meaning you can finally, it's been a long time coming, but yeah, the PayPal ecosystem was not really built as well as the Block ecosystem, but finally you can begin sending money for free from your Venmo to your PayPal account. And this is thanks to the Visa plus P2P payments. Now, I've already seen a couple of people laugh about this announcement, saying that, well, PayPal and Venmo, they needed Visa Plus to make their own products work well together. While right now it's true that it facilitates the process and it's about damn time that it made this process way easier and free. But in the future, as PayPal stablecoin grows in popularity, more people use that. One, it's going to be cheaper for us, the users, to send money. And two, it's going to be way more profitable for PayPal as well, because they do not have to go through the Visas and the MasterCards of the payment universe. No, it's all going to happen inside their own ecosystem. And so from a profitability side of things, for the business, it's going to be much, much more lucrative. And for us, the users, it's probably going to be cheaper as well. So there you have it. Two hated, beaten down stocks and companies I do still think that are worth your while. PayPal, Alibaba. Of course, do share your thoughts down in the comment section below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.